welcome to this video blog, which is a complimentary video to, or at least complements the blog that we have recently released in terms of that focuses on risk management for winners. So there are 5 key points that we're focusing on, starting off with planning our trades. All right, so by failing to prepare, you're preparing to fail. These are the words of Benjamin Franklin. And really the point of this is that we do need to have identified our trade setup. We should know where we're getting in, where we're getting out if the trade's going to go against us, and where we're looking to take profit if the trade goes in our favor. Moving on to point number 2, which is risking only what you're prepared to lose, right? This is really making sure that we're not, because first of all, we're going to make most of our mistakes in the beginning, right? Because that's when we don't even know what we don't know. So we will make more of our mistakes in the beginning. We don't want those to cost us too much financially. There's an expression called school fees, which is obviously when we pay for our mistakes, but in trading, we can actually pay money for that. We don't really want to do that. So we want to make sure that we are very sensible and conservative when it actually comes to exposing our capital in the trades, at least in the beginning, while we are still improving our technical analysis and still becoming familiar with the platform and the entire process and starting to master our strategy. So when we talk about risking only what we're prepared to lose, it should be capital that we can replace if need be, certainly in the early stages. Over time, we will grow our own capital and it will become independent of other capital that we have. So we start off obviously and just make sure that as a habit, we risk only what we can actually afford to lose. So that if we had to start again, hypothetically speaking, it shouldn't happen if we do everything the right way, that we are able to, though we don't put ourselves in a position whereby we add debt to our situation that costs us more than we can really afford, not even just in terms of actual money value. Next, point number 3 is following the 1 to 3% risk rule. All right, so the future is unpredictable. Obviously, the outcome of trades is based on probabilities and experience, and the one thing that is largely within our control is risk. All right, so we can control to a degree what we lose. We just can't control the markets and therefore can't control the outcome. But what we can do is determine the probabilities of us making profit. So what we do is, because we cannot predict, of course, which of our trades will be losing trades, which will be winning trades, it doesn't really allow us to pick and choose where we add our risk or how we allocate our percentage risk per trade. So what we need to do is treat each trade equally and therefore appropriate risk according to what we can afford in our account in terms of our margin, in terms of our trading plan, our risk management rules, which may be 1%, it may be 2% or 3% per trade. We need to make sure we do this democratically amongst our trades. And this is very important because what this does is allows the statistics of the probabilities to play out, meaning that we will lose the same amounts on our losing trades or less, but not more. And of course, it leaves us open to profits on our profitable trades. Point number 4 is always using stop loss orders, right? The single biggest losses that all traders have experienced throughout their careers have really been when they have decided they were too good or too professional, or they could beat the market without the use of stop loss orders, and they didn't get out of the market when they should. All right, that's the single biggest killer of both professionals and beginner traders who stray from this rule. All right, so we always use stop loss orders. In fact, the way to think about it, for example, is that if we do go to bed, we want to wake up, we'd rather that our loss is obviously minimalized, and the way to think of a stop loss is to approach it in terms of mindset as a bulletproof vest or a parachute. Its sole purpose for existence is to minimize the damages from losing trades to minimize the damage on our capital from losing trades. Basically, when we look at the chart, we're going to put our stop loss at a point where if the market goes past it, we absolutely want to get out of that trade. There's no disputing it. We definitely want to get out. And so stop loss orders are there really to protect our existing capital. And as we take profit, we grow our account. So just understand that that is their existence. That's their whole purpose for existence. That's their reason for being. Point number 5. Wrapping this up, following our strategy. All right, it's going to take time to master our technical analysis and learn to master our strategy, to become very familiar with it. And there's no such thing as a holy grail. There isn't a strategy that never loses and only wins all of the time. It doesn't work that way. Professional traders use obviously a strategy that is proven and learn to master it, and then their win ratio goes up and their profits go up. All right, they still have losing trades, but the probabilities tend to favor those who master this and put the effort in. All right, and so basically trading obviously comes with high levels of risk. We do need to know what we are doing, and if you'd like to speak to an expert trader to discuss your risk management strategy, then please book a call here. I hope you enjoyed this blog and this video blog as well to accompany it, and we will see you in future video blogs. Thank you.